All right, let's continue our discussion on mutual funds. Different types of mutual funds. Again, continuing on, you can look at sector funds. Maybe you want to invest in the telecommunications industry, or you want to invest in companies that are involved in technology. So they look at one specific part of the sector. Primary objective is looking for capital gains. Typically, these are looked at as being a little bit more speculative because your analysis is going to be a little bit deeper. You're really looking to find those things that have the opportunity to grow a little bit more than anything else. And of course, that increases the investment risk that you have on your investment choices. Socially responsible funds. These are particularly important for clerics, right? They want to invest in the stock market. They want to earn a return. But quite frankly, these guys don't want to invest, or these people don't want to invest in tobacco, alcohol, gambling, nuclear energy. So these are mutual funds that eliminate companies from their choices that don't act the way they want them to act. So again, if the stocks don't meet these tests, if they're going to exclude them, then they have a smaller universe to look at as far as their choices. Now you might think that, well, that's really a good thing. We're only going to go buy, in quotes, companies that are good companies. But quite frankly, the companies that have the highest rates of returns are typically defense industries, tobacco, alcohol. These are high profit companies and industries. So we might be limiting our return potential by outlying or outlawing some of these companies. But again, for certain individuals, they're willing to give up 1% or 2% of return overall so that they can feel good about what they've invested in. Asset allocation funds are going to spread their money out across a variety of things. So an asset allocation fund might actually be referred to as, sometimes they call these mutual funds of mutual funds. So they're going to invest in mutual funds. So they'll buy 3 or 4 mutual funds that will match the investment needs of an individual. So if you're an aggressive growth person, you could buy an aggressive growth asset allocation fund, and they would spread your investments over mutual funds that would match your investment needs as an aggressive growth investor. So it's kind of a one-stop shopping. You don't have to buy 7 funds to meet your goals. You can buy one fund, and that one fund its objective is to meet your goals. International funds are a little bit different. It's kind of important to talk about because the reason we like to invest in international mutual funds is we're interested in diversification. There's growth opportunities, but quite frankly, most other countries, their economies don't match or correlate well with United States market conditions. So if we can combine these economies that do not act alike, by definition, we are spreading our eggs out even to a greater number of baskets, or our money out into more baskets. We can get potentially higher growth, but we also get a greater level of diversification. Again, once we go international, though, we have other risks we have to think about. We have to worry about currency exchange. We have to worry about political risks. So it is a different ball game, but again, the purpose is to diversify our risk even farther than what we've been able to just within the domestic market, for instance. So next, let's talk about some services that you get. We mentioned them in the very beginning here. There are things called automatic investment plans. Quite simply, you call them up, you say, look, I want you to send me money. I want to send you money every month. I don't want to write a check. Take it out of my checking account. So on the 10th of every month, they're going to withdraw your investment in this mutual fund, and it goes right into the mutual fund, right from your checking account. It's an easy way. You don't see it going. You don't have to write the check. So it's an easier way to get your money invested. By default, most mutual fund companies will automatically reinvest any of your interest, dividends, or capital gains. They just do that as its very nature. That's the default. If you actually want them to send you the money, you actually have to tell them to send you the money. What's a systematic withdrawal plan? I mean, what are you going to get when you get to retirement? What are you going to do? Let's say you have $1 million in your mutual fund portfolio when you get to retirement. How are you going to get your money back out? How much money do you want to get back out? So you can call them and say, look, I've got $1 million there. I need $2,000 a month to live on. Send me my $2,000 every month, and they'll send you a check on this systematic basis. They'll even withdraw some taxes if you need to withdraw taxes. So they'll take care of all of those things so that you can get the money you need during retirement, for instance. How do you change your investment portfolio? We were talking about bond portfolios. We're saying this concept of a laddered approach where you're going to have to buy and sell stocks, right? Where you're going to have to try to match, even when we're talking about immunization, you have to match the duration to your investment horizon. That implies that you have to buy and sell stocks or bonds. If you do that within the same fund family, then there's no sales charge. Now there's a tax, but there's no sales charge. So if you need to alter your investment portfolio, maybe you're getting a little older and you're really a little bit worried about risk and you want to reduce the risk of your portfolio. So you want to you want to move into some other funds. As long as you move them to other funds within the same fund family, then there's no sales charge. Only a tax would be paid. And quite frankly, I think this is just a good point to say, when you want to decide to buy a mutual fund, you need to first find a mutual fund family. Almost all mutual fund families, if you know their names, right, if they are the popular names, these are big companies. They have hundreds of choices to pick from. Do they have some choices that are not so good? Absolutely. Do they have choices that are good? Absolutely. So pick a mutual fund company. American, Fidelity, Oppenheimer, Franklin Templeton. There's probably 10 that you can probably think of that are all excellent, good companies. They have many choices. Where you have to worry is if you have a mutual fund company that maybe only has 3 or 4 choices. Because not only are your choices limited, but also where do you move if you want to exchange within the fund family? They don't have many things to go to. You can set this up so that you can do make your changes by phone. It's pretty easy to set up a retirement account. An IRA account is typically always set up through these mutual fund types of companies. So, why do we use mutual funds? Well, there's only 3 reasons really why anybody invests. Now, for mutual funds, the first 2 of these are really the only legitimate reasons for mutual funds. You are trying to either accumulate value or you're trying to store value. Those are the things that you're trying to do. Trying to grow your wealth, or you want to find a place where you can have some capital appreciation. Speculation and or short-term trading in mutual funds is actually contrary to a mutual fund. Mutual funds, by definition, even if they're short-term, like money market accounts, even if they're short-term, look at a long-term investment horizon. They're looking at a longer-term lifespan of their investors. So if you short-term trade something that has a strategy of long-term, you are working contrary to what you're paying for. So speculation and short-term trading are really, although they are legitimate, reasons why, they are not especially good reasons why you would want to use a mutual fund. The other 2 are the primary reasons. So again, coming back to this, you need to determine if you want to use mutual funds in a portfolio. You want to increase diversification. You want to get some expertise in maybe some areas that you might not be that well informed. Again, you can use stocks and mutual funds. You can combine your portfolio. So essentially what we want to do is you want to compare a mutual fund's investment objective to your objective. You want to compare the services that are offered. Quite frankly, I think this is kind of a futile thing to compare because all mutual funds offer the exact same services. So we need to compare the objective. You then ultimately want to compare the fees. What are the expenses of owning these different funds? The fees are different, right? So what do you want to do? You want to find out, do you want to use mutual funds? Then you need to start analyzing them. Find mutual funds that meet your objective. Find of those mutual funds, find those with the highest rates of returns and the lowest expenses. And again, services are important, but they're fairly similar across the board for different types of funds. Where can you find information? There's information everywhere. Quite frankly, I think Morningstar Mutual Funds, Morningstar.com, is probably the place to go to get mutual fund information. They have lots of information. It's very easy to get, very easy to find, very easy to analyze. They'll give you definitions of terms. They have screening tools that you can screen by different variables. But there's a variety of things that Morningstar offers. The service is free. What I'll tell you is that when you go out there, they're going to offer you a premium, right? You don't need to buy it. You just say, nope, thanks, I don't want it. Send me right to the mutual fund or to Morningstar.com, and it will bypass that premium tool. But what that also means is the premiums offer you tools that are maybe better tools. So you have to decide how much you're going to use this, whether it makes sense to pay for it or not. So again, what are the factors in exploring how to find mutual funds, right? You need to look at their investment performance. Determine tax efficiency. There are tax efficiency data points given in Morningstar. They'll analyze tax efficiency for you. Understand the fee structure. Find out how it fits into your portfolio. Understand the investment skills of fund managers. Maybe you don't want to buy a mutual fund that is managed by mutual fund money managers who have only been out of school for the last 3 years, right? You want somebody that has some experience, somebody that's been investing for 10, 15, 20 years. Decide whether you want load or no load funds, whether you want closed-end or open-end funds. I mean, those are the basic choices you have when you're deciding what kinds of mutual funds to purchase. In kind of in conclusion here, right? How do we find out what the prices are, right? We want to compare these things. Commissions are what they are. You pay commissions to buy things. Open-end funds have greater liquidity, but closed-end funds could be trading at premiums. So what is the premium of a closed-end fund? You take the share price, whatever the price is, minus the NAV. The NAV is given for these closed-end funds. So again, whatever this is, divided by its NAV, and that will tell you whether you're paying a premium or a discount. The higher the premium, the more you're paying above and beyond the value of the asset that you're buying. You want to be very careful with that. You want to make sure that maybe the demand for this thing is not exceeding the actual values that it's providing. You want to understand about how you're going to get paid, right? You get paid for mutual funds essentially 3 ways. Dividend income or interest income. This is typically paid monthly. So you can get a check, not usually, but usually you can get or buy new shares every month from the distribution of dividend income. Capital gains income is paid but once a year. At the end of the year, by law, they can only pay it once a year. A mutual fund will pay a capital gains distribution. Now, it could be a gain or a loss, depending on how well they manage the portfolio. Were they selling stocks that they made money on, or were they liquidating stocks that they had losses on? Again, that's a source of income. So you get money from the current income, just like you would a stock. You get money from changes of the stock price, right? This is within the company, if you will. But then also the portfolio itself changes value, right? The NAV of the stock, the assets sitting in these portfolios, their values rise and fall with the marketplace. So there's three ways you make money when you buy a mutual fund. To find the return is a fairly complicated process. First of all, we need to know how many shares did you have at the end of the period times the ending price. You need to subtract from that the number of shares you had at the beginning period times the initial price. Now here's the problem with this. What happens if you bought shares every month? You don't have the same number of shares at the beginning, at the end, right? In January, you bought 100 shares, February 100, March 100. You really need to calculate your returns on all of those things. This is a very simplified holding period calculation. Shares at the end times the ending price, shares at the beginning times the initial price, again divided by your beginning investment. That is the holding period return. The actual return that you get is a much more complicated calculation that's obviously beyond this course. So that's the third part of the mutual fund chapter. See you in the next chapter.